Baie dankie vir die geleentheid om hier te wees. Dit is altyd 'n voorreg om met boere te kom gesels. Ons boer self, maar daar in die somergebied, so ek leer altyd baie as ek hier onder is, maar baie dankie vir die geleentheid. Dankie ook vir die PNS om my hier af te bring en al die dinge wat ek by julle leer. Ladies and gentlemen, what I want to talk to you about is just more the bigger picture things of where canola fits in. What are the opportunities? Mega trends, more in terms of your consumption patterns globally. How does canola compare the pricing of canola with other oil seeds, and the way forward, obviously more specifically for the profitability of the farmer, and then generally just also the competitiveness of the farmer, the canola farmer. Okay, why is canola important? And we've developed this graph. It's a bit busy, but I hope it makes sense to you. That we just give a high level view, and this has worked really well for government, just to give an explanation of what do we eat and what are we producing and what are we importing and where are we competitive. Now this graph here gives you on the x-axis, it says the percentage share that our consumers, and I know this is the average consumer in South Africa, there's nothing like an average. You have high income and you have low income. But if we just take the whole population, we say, what are we spending our money on, percentage-wise? We spend 10% of all our food expenditure goes to poultry. That's a lot. One single commodity that receives about 10% of the total budget. Beef, just under 8, wheat, just over 8, that's bread, obviously. Then comes in milk and maize meal, cool drinks. Here we've got sugar. There we've got the edible oils. That's where canola oil also starts to feature. Still the majority is obviously sunflower oil, palm oil, soybean oil. But this is just to, in terms of a ranking, in terms of expenditure, the edible oils are high up, but then look at your other byproduct. That is the cake. So the feed demand is huge, because of the amount of consumption that we also domestically have in terms of poultry and beef. Now, on this graph, we have another axis here, the y-axis, which gives you the level of production or trade relative to our local consumption. In other words, if you have something above the line, it tells you we are importing this commodity, simply speaking. If we have it below the line, it is what are we exporting. And this gives you a bit of an impression saying out of the top commodities that we are consuming, we are importing poultry, beef, wheat, mutton or lamb, sheep meat, edible oils, rice. We're obviously importing 100% of all our rice. We're not producing rice. But we are importing about, say, 25-30% of our wheat. We are importing about 18% of our poultry. This was the picture in 2005. We're exporting maize, exporting sugar, milk, eggs, those we are almost self-sufficient. Now, if we pull in 2010, how has this moved? How has this position moved, relatively speaking? Here we can see poultry. We are spending a little bit more even on poultry. Beef, spending more on beef. But what's also interesting is to see the relative position also in terms of trade. Have we made progress in terms of local production or not? And here you can see poultry is almost on the same level. Beef, we've kind of moved into a more self-sufficient position. Wheat, what has happened to wheat? We are importing more wheat, percentage-wise. So continuously moving up on that ladder. Okay, maize meal, we're actually moving more towards self-sufficiency, exporting less maize. I know this season it's now a bumper crop. We'll export more again. So that bubble will come down. Sugar, we've been moving backwards. We're consuming less sugar and we're exporting less sugar. Edible oils, we are spending more on edible oils, and the position over that period of time hasn't changed much. That position we're anticipating that position to change. If we were to look 10 years ahead, with all the soybean crushing going on, and also the canola making its contribution on a smaller scale, you could potentially see that position improving depending how fast we expand our consumption of edible oils. But I think this gives you a little bit of an overview of where are we spending our money, our consumers, and what are we importing, where are we competitive. And these dots just give us a relative view for the next 10 years. And here, for example, wheat, we're anticipating that we'll import even more wheat over the next 10 years. And we'll move along and probably eat a little bit more bread in terms of consumption. There's still consumers moving more into bread, moving out of maize meal. Beef is moving towards a more self-sufficiency. Poultry, still importing a lot of poultry meat. Okay, so we can look at it differently and just split it up. Very nice, simple graph, just saying, what are we importing? That's the blue part. What are we exporting? What are we importing? And this is in rand terms. So obviously the net effect, these are the top 10, or the top 6 exporting commodities and top 6 importing commodities. And here you can see our products featuring again, soybean oil, palm oil, soybean cake, poultry meat. That's the game that we are in if we are producing and processing canola. That's the market that we're in. So this is really a market where we have a lot of opportunity in terms of we are importing all these products, and we are also importing the product that we're feeding, in other words, the poultry meat. Okay, so this just gives you a bit of a feel and what's important for government, and this is also something, a key message that we're always trying to bring across. It doesn't imply that we have to produce everything in South Africa. We have to be clear about that. We need to produce that where we are competitive and we can create jobs. That's one of the key messages, that we cannot just throw away these industries where we are competitive and generating jobs, but it doesn't imply that we need to neglect these industries. So focusing at the industries where we can really make the advantage, produce it competitively, and grow over time. Okay, so 2023, what's our view? Can we be positive about the next 10 years? And what are the key drivers? And I'll give no one hand and other hand, Jos. Just key drivers. One message. Too much poultry. Okay. Okay. Net farming income. This is what BFAP did to net farming income in the country. No, this is actually what the market gave us. If you look at net farming income in real terms, it's been relatively, there are cycles in it, but if you pull a line through these years over here, not going anywhere really for a number of years. And then in came this rapid growth in China and also the biofuels industry in the US. So we shifted almost like 100 million tons of maize suddenly had a new market, which was the ethanol market. On top of that, Chinese economy grew by a healthy 10%, India following with about 7%. So it caused this huge demand for oilseeds, and the grains went into ethanol, and the world market really just exploded. Prices rocketed. And that made our industry very attractive and very profitable. You all saw what happened to farm prices. And you've probably seen some of the stories in terms of investments in Africa. Why? Because the hedge funds were seeing bigger profits coming in. So the question is, will these profits remain over the next 10 years? Where are we going? Can we maintain these high level of net farming income or the profit levels? Let's have a look. And my philosophy is always this old pendulum, a market pendulum. And my approach to this is saying that in agriculture, this pendulum swings much further out than what we have in normal businesses because of biological cycles. It takes time to adjust. So if we've had a drought in the US, we've had 3 droughts now in succession. If we see what has happened there, what farmers have planted, how far the prices have responded, one can anticipate this pendulum swinging back. So last year when we did the baseline, we said, prices are coming down, and then the US had another drought, and the pendulum swung out even further. But this year, the US is having a bumper crop. And what has happened to the world prices? They've come down by 30-40%. we have to some extent been cushioned by the depreciation in the rand. To a large extent also the wheat industry and the canola industry in terms of the oil and the cake. So yes, the weakening of the rand has cushioned off some of the depreciation or the drop in the world prices. But still, colleagues, the world prices are much lower. The world is sitting on a much, much bigger crop, and that influences our forecast going forward. We have stock levels now in the US and in Europe that could last us for another year or two, depending on, obviously then we need normal weather patterns. Okay, so if we would have another drought next year, obviously your weather patterns always play a big role. What are the other key macroeconomic drivers? Population growth, we just talked about what people are eating and what's important about it. How much more will they eat? And this determines the demand and supply balance. And that's critical. So if we have a population growth that is slowing down, it tells you something about the growth rate in consumption patterns over the next 10 years. Further on, it's not only about the growth rate of population, but also what are these people earning? Are they earning more or less in real terms? And then obviously our exchange rate. So let's just look at some of these graphs. That's our population in South Africa, currently at about 50 million, and the forecast is 54 million over the next 10 years. So if you look at the growth rate, then it has been declining quite a bit over the past decade, and it's expected to continue to decline. So our population is growing not fast, but we do have a lot of immigrants coming into the country who are consuming a lot of the basic staple food. Economic growth rate, every year that BFAP has done the baseline, we had to bring down the economic growth rate. So if you merge those two, slowing population growth and your lower GDP income, it gives you a key message of less disposable income going over the next 10 years than what we've had over the last, or slower growth in exposable income. So we cannot expect the same level of increase in demand than what we've had over the last 10 years, especially in terms of something like chicken meat, where it's really, we are moving a lot less people into higher income categories. So just put this differently, this is the living standard measures. This is the South African population if we do take various income levels into consideration. So what this graph is telling us, we, for example, in 2004, we had almost 10% of the South African population living in absolute poverty. With all the social grants and support, we've reduced this population, this share, to about 1%. So that's a good job. We've managed to do that, but that's through social grants. Look at all of these arrows. We've reduced these categories of poorer income households, and we've put them into higher income households. That has happened over the last 10 years. But that speed is slowing down, okay, especially in this middle income group. This is where it's really hitting the hardest. So just to give you these are pictures that we took from the World Bank report there. Some of you might have seen this. This is just to give you an impression of what does it mean in terms of volumes, earning more and changing your consumption patterns. This is a family in West Africa. That's their ration for the week. This is a family in Mexico, ration for a week. And this is the family in Germany, ration for a week. So you can, yeah, the beer is there. Is the beer? Yes, yeah, there's enough beer as well. Okay. But apart from the volumes, look at the level of processing. Value chains, okay, taking place in this whole process. Now imagine that the implication if you move a lot of people out of a lower LSM group into a higher LSM group, the opportunities that there are. Those opportunities are on our continent. So we're still moving, but we're moving a bit slower, but there's still ample opportunity for the industry that we're in. Whether you're a processor, or whether you're a farmer, whichever business you're in, whether you're selling technology, there's a huge, huge, huge opportunity in this industry. It's just growing. The next decade will be growing at a slower pace than what we've had it. And that's narrowing down our margins. So coming back to What Dave said is we need to be smart about the business and manage our risks if we're going forward in these margins. So this was just a picture in terms of the population in Africa. Okay, and just to prove it that these consumption patterns are changing in Africa, look at our apple exports. Apple exports in 2006, we exported 11% of all our apples that we were exporting went to Africa. And it moved up to 24%, and it's now at 28%. The largest share of our apples are going into Africa, not into Europe anymore. So those markets are shifting. And apples is not a basic staple. So we are having that middle income category in Africa moving along and demanding a lot more. And veggie oils, by the way, is also falling into that category. Exchange rate, I cannot honestly stand here and tell you where the exchange rate will be. So it's not on the one hand or on the other side, and there's nobody that can tell you where the exchange rate will go. And if they are telling you, they're lying. Okay, so we really don't know. There's a lot of uncertainty in the exchange rate. And every year, and what this graph is telling you, every year when you listen to us in the baseline, we were projecting a slower depreciation in the exchange rate. If you just look at our factor productivity and our labor forces, we cannot compute our exchange rate has to depreciate to keep competitive, in relative terms, a parity in the world. However, the level at which the rate it will decrease, we don't know. Okay, so it has happened faster than what we've anticipated, and every year we had to come back and depreciate our rand. And that, to some extent, on the product side, output side, it gives us an advantage. Over the long run, it makes the country poorer, because eventually it will affect our inflation rate, and it will affect our interest rates, and that will have an impact on our land prices and etc. All of that. Okay. So internationally, that's enough of the macro markets. Let's look at the international markets. Oil and maize, I've mentioned that to you already. The ethanol game, that was very important. That moved the global markets into a much higher level. The ethanol game, what the Americans now refer to as a blending wall, they've now achieved a 10% blending mandate. So in other words, they've set a target of putting 10% of their fuel, replacing that with renewable fuel from maize, the bioethanol. That mandate has been reached. The question is now, what are the Americans going to do now? Are they going to increase that blend wall or not? The fleet, the American fleet, the vehicles cannot take a E15, currently as it is. So seeing in the near future, E15 is not on the table. Okay, in fact, they're starting to back down. So having more maize going into the ethanol industry is unlikely. So we don't see that rapid growth in demand for maize. And that's why going forward, our maize prices look relatively flat. Not that rapid expansion anymore. Now, that also implies that this beautiful link that we had between maize and oil, and a lot of economists were projecting that now it's a perfect correlation between oil and maize. That's not true. Because once we've hit that mandate, it will give us a support and the lower base, which is good news. But on the direct correlation between oil and maize is not there anymore. Okay, and this is another new player, is the gas, natural gas, the fracking. Gas prices in the US have come down quite a bit. Okay, whereas oil prices have increased, gas prices have come down. This is a reality. What does this imply for energy? You can imagine that. They're becoming more effective, more competitive. And if we look at fertilizer prices, these are the projections of our colleagues in the US. They are anticipating that American fertilizer prices will come down. Look at those years there, 2014, 2015, 2016. And the byproduct of gas is fertilizer, is the ammonia. So whereas the US is currently a net importer of ammonia, they're projected to become a net exporter of ammonia. So worldwide, that could have a positive impact on fertilizer prices. But obviously, they'll benefit from it first. So you can expect more competition coming from the US in terms of the cost of production. Okay, so just to come back then to the prices, I've already mentioned this. This is the maize price. That's the wheat price. Wheat prices eventually will have to follow maize prices. So maize prices have have declined quite a bit. Eventually the wheat price will follow and has already started following. The dip was not as hard, the peak was not as high, but eventually these have to trade within a band. So in Europe, wheat is also used as a feed, competes with maize. So within the world market, these relationships will have to be established. So over the long run, you can still see the plateau is higher. We're not falling all the way back to where we were. So that biofuel game gives us a support level. The cost structures have moved in. So, but the bottom line is still 30% almost lower than what we've had. So look out for this decline in commodity prices. Okay. On the oilseed side then, coming to our canola game, this was really the key driver. We talked about China, and this is going to keep on supporting the oilseed industry. We do have this support coming in continuously. So if you look at the oilseed demand, the imports into China, just look at this graph. 2006, less than 40 million tons. That was the amount that they imported. By 2014, they doubled that to 80 million tons. And we're anticipating this to grow to 100 million tons. You can see the growth is slowing down. China's economy is slowing down, the growth, but still a very healthy growth. And we'll have to feed that market, and this gives us a nice support in the oilseed game. Prices, however, have already started declining. Now look at these prices. This is the canola is the blue price, sunflower is the red price, soybean is the green price. And this is the whole oilseed complex, referred to as the oilseed complex, and these prices have to move in relation to one another, oil and the cake. That's very important. So you can see this decline in international prices, and we're going to see we've already started feeling the pressure here. You've seen the sunflower prices come down, soybean prices come down, and your canola prices come down. And this is basically feeding in from the world market. And we're expecting this trend to continue for another 2 years of lower prices. Okay? But over the long run, how low is low? We think that the decline that we've seen now, that's it. We'll start to see the production levels reducing because farmers are around about the break-even point now. Also internationally, if you look at Brazil, Argentina, Europe, this is really where we're getting very close to break-even. So this, the fall that we've seen, this another 25-30% fall, this seems to be the level that we'll ease out going forward. But important, look at that correlation between canola and a commodity like sunflower or soybeans, which might be, and this is, we'll come to the pricing mechanism just now, might be an option for you for a hedge going forward. Okay. In terms of biofuels, a lot of people are asking us, what are the options for biodiesel? Just want to make this very clear. Biodiesel, if you sell a liter of vegetable oil now, and the soil people can help us here, but let's say give or take import parity is 11 Rand 50 a liter, 10 Rand 50 a liter. What's the oil company going to pay for that liter? The basic fuel price, unless they are forced to pay more. But the basic fuel price is 7 Rand 80, 8 Rand a liter. So without a significant government subsidy or some pricing scheme within the biodiesel industry, don't think that biodiesel is going to make the situation any better. Your veggie oil market, we're still net importers of the veggie oil, so rather go for the human consumption market. And the biodiesel story in Europe is getting flatter and flatter by the year. Look at that. So even getting less biodiesel produced in Europe, and rather moving into new technologies of biodiesel production, where you use your cellulosic processes. Okay, so what does this all mean for our local market? We've talked about this graph. As you earn more, you're eating less maize meal, and you're eating more bread. We've talked about the meat market. You already can anticipate these numbers now. We've said the meat demand is going to grow slower than what we've had the last 10 years. So in other words, we grew by 81%, and the growth in chicken consumption is only expected to be 34% going over the next 10 years. So still good growth. America or developed countries would be very happy with a 30 or 40% growth. But in our terms, coming out of 81%, it's slower. There are commodities like sheep meat, and this is an important industry for you. It has declined. Look at that decline there in the demand for sheep meat. 17% down, much higher prices, but prices are moving more in relation now to other beef prices or meat prices. And we're anticipating that sheep meat consumption will pick up again. So don't get rid of your sheep yet. Rather keep them in your business with lower commodity prices and sheep meat picking up the consumption again. I would maybe consider keeping those animals on your field in a rotational system. But here's also pork, healthy increases. Look at that, 41% increase. Pork meat increased by 53%, slightly slower, but still a very nice, healthy expansion in demand for pork meat. Same for eggs. How are the farmers going to respond to all of this? So you've seen the macro picture, energy, competition from the world market, your demand, what are the consumers doing? So let's just look at the farmers. White maize area is declining. It has been declining and it's still declining. Now, interesting enough, 2014, we're sitting at about 1.5 million hectares of maize. Okay, for white maize, and yellow maize around just over 1 million hectares, 1.2 million hectares. This trend will continue forward, and we'll continue shifting white maize area out into yellow maize and into soybeans. Okay, so if I pull in, these are the wheat graphs, that's sunflower, that's soybeans. Okay, so this increase in soybeans will to a large extent come from white maize, and a little bit also from sunflower. Now, just to give you some technology growth and what's really boosting competitiveness. There's the yields currently. Our projections are that white maize yields, the average yields will be at 5.8 tons per hectare by 2023. We're currently, this year, we're sitting at 5.65 tons a hectare. So that's how high this year. It's really an exceptional year, and I don't know whether you saw the crop estimates yesterday, 14.3 or the day before yesterday, 14.3 million tons. That's basically our largest crop. In 1981, we had 14.3 million tons on 4.5 million hectares. We're producing it now on 2.7 million hectares. So that's nice technology growth. And if we look at wheat, let's look at this. This is the summer area, that's the gray bar, and this is the winter wheat area, your area. Now this graph only goes back to 1994. Now if I would pull this back to the 80s, do you know how much hectares did you plant here? Just over 800,000, 900,000 hectares of wheat. We are down to 300,000 hectares of wheat. And if we look at yields, they've improved rapidly over the last 3 or 4 years. I know they've been exceptional years, very good years, but the productivity had to grow to remain competitive in this world market. But the drop in the summer area, that's the Free State, has been even worse. So there we've had over 1 million hectares of wheat and now producing only 176,000, and we're anticipating that this area is still going to come down. That little drop there in the winter wheat area going forward, we're anticipating that that will go into canola. So our projection for canola is about 110, 108,000 hectares by 2023. And the total production, if I pull in this graph, about 180,000 tons. So we are slightly less ambitious than the graph that Gerard put up. For our yields, we had about 1.8 tons per hectare over the next 10 years. So slightly under the target of that 210,000 tons, around about 180,000 tons. But prices, let's just talk about these prices here. We've had the high prices, 4,500, 4,700 Rand a ton, but these prices coming down. 2014, 2015, 2 more years of lower prices. That's just feeding in the international prices into the canola model and generating those prices. So we are anticipating lower prices and then starting to ease out again. What's causing that increase? The weaker Rand feeding into our oil and cake prices, as well as a global market that's gradually starting to move out of this surplus stock situation. Okay. Now, just in terms of prices, this graph, Franco gave me some better information from what I had yesterday. This is the import-export parity band. for canola seed. That's the local price that's reported by Grain South Africa. Now it's difficult because it's not trading on SAFEX to compare these prices, to track them day by day. So there's not a daily futures price for canola. So what's happening here, what I've put in are two prices basically. That's a local price, which is actually referred to as the final price. That's the one that Grain SA publishes on their website. But this price here is the price that farmers realized, and I would call this the farm gate price, after the agterskot has been paid out. Okay, so that gives you a better indication of where these prices in relative terms, where they were lying. So the way I read this would be that the price there, that was the spot price, or the final, what they call the farm final price, and then this uptake in the market there, whatever was sold or realized in terms of profits on oil and cake was then put back in the form of an agterskot, I don't know a better word for that, to the farmer and lifted that price there. There wasn't not a much to make in the market. There again, that uptake there was put back into that price there. That's how to read. That's pretty much how you can read this graph. The challenge is, however, that you have prices, you have this type of a market movement, and this is the oilseed complex. This is the reality. So can you hedge it? Can the farmers hedge, and can the processors hedge this price? Because there's no futures market for it. And hedging is a very important tool to take out the risk. Because potentially that price, if we would pull this price further, it could come down. We've talked about this decline here. But for next year or two, the price could be very low. However, if we have a drought somewhere in the world, this price could run up again. So how can you hedge? And if you just look at some of the links, and this is not easy, but when we did our initial analyses, you can look at a sunflower price. Could that be a potential hedge for a canola price, producer as well as a consumer, a processor? So maybe going to look at the sunflower's futures price. I know it's a very volatile contract, maybe the soybean price. So there might be options for you to engage the futures market, following this pricing mechanism, fix the prices here, but still engage in and hedge on the futures price. Now, to some extent, this agterskot should cover some of that potential increase in the price. But you as farmer could engage in the same mechanism as well, to some extent, to try and limit that upward price risk. Downward price risk, your down price is obviously covered if you have a fixed price. If you fix your price at the beginning of the season, you know what your lowest price, the minimum price, is going to be for that season. I just want to show you this, and we'll get to some of these adjustments in this canola industry as the industry is growing. It's not easy. And the soybean industry is currently experiencing a very volatile, there are tough times now, because a lot of capital has gone into the processing capacity of soybeans. So we've got huge processing capacities, and look what has happened to the pricing structure of soybeans, the seed. Whereas we were trading at export parity for quite a number of years in soybeans. Look what has happened here. And this is something that we projected last year, and it's happening, and our forecast is that this pricing structure will remain in place. What has happened? We've moved away from export parity into a space where we have a derived price of beans. And it's derived from the oil and the cake, the byproduct. So soybeans has broken away from the export parity base, and because we've got this additional crushing capacity, we can actually now process the bean to a cake and an oil, and then it just depends on the crushing margin. So on average, these prices are starting to move within the space and not at the export parity level anymore. And I know there are tough times out there for the crushers to sell their oil, get into the market penetration. The cake, they're taking big knocks currently, between 300 and 500 Rand discount on the cake to penetrate that market. But it will sort itself out over time, and as our local production grows. Gross margins, And I'm almost at the end now. Canola, if we just look at canola, this is the Oeverberg farm. I have to apologize, we'll get into your area as well, Jan and Louis. We're going to capture your farms as well. So just looking at the canola margins here, this is a rand per hectare margin. In our forecast, 14-15 season, the next season, margins are down. So this was not taking your excellent potential yields into consideration. So we did take normal yields from last year into consideration, and you might actually realize more depending on your yield. Lastly, just why is it so important to look at the yields and the competitiveness? We talked to that, Dave already talked about that a lot. It's just the relative costs. And what we then do is we take your data and compare that in this agri-benchmark network. And here we have colleagues in Argentina and Germany, Russia, US, South Africa. And we're comparing apples with apples. They also have these typical farms, representative farms. And then we try and see what are the costs per ton, the production costs per ton, and how do they compare to other countries across the world. And here you can see, this is, for example, the Oeverberg farm. This is a 2,500 hectare wheat farm. We don't have it for canola yet, but here you can see that the relative costs of production are high compared to, for example, the US, the Germans. That German farm there, that was a 360 hectare farm. That's the largest farm in Germany. That's a slightly smaller farm, 240 hectares. Here's a 330 hectare Argentinian farm. Look at their production costs per ton. So in any case, you can draw some comparisons and also look within the component. Which components are high in South Africa? Fertilizer costs are high compared to, look for example, for Germany. Look at those much lower costs in terms of fertilizer. So these are comparisons where you can compare farming systems and the relative cost of production. Lastly, this is the type of story that we're seeing happening now with soybeans. This is actual data. You have area increasing, and I've put a linear trend on it, and you've got production increasing. But look at that trend comparison. The production is increasing faster than the area. And that's good news. So that's what you want. You want an expansion in the area and an increase in yield. You don't want the other way around. And I think in the last 3 or 4 years, we've seen that also for canola. Increasing yields and increasing area. So well done on that. And then what you then get competitiveness. Then you can produce and you can drive down the level of imports. That's for cake. And you can increase the level of local production. And then you're creating a positive industry and a positive environment, macroeconomic environment. So coming back then to real net farming real net farm income, that's our projection going forward. Okay, so here we've got net farming income. We're expecting these net farm incomes to come down 2014, 2015, and by 2016 moving out and increasing again. And that's my story. Thank you very much.